The UK property market is lying to you. If you turn on the news right now, they'll tell you prices are stabilizing. They'll tell you the worst is over. They'll tell you the storm has passed. But what if I told you that the data suggest we haven't even entered the eye of the storm yet? Right now, beneath the surface of the headlines, a quiet mathematical shift is happening in the UK housing market that is statistically guaranteed to wipe out billions in equity. Most homeowners won't see it coming until the letter from the bank hits the doormat. Most amateur investors are currently buying assets that will be liabilities within 24 months. There is a gap, a massive, widening gap between what sellers think their homes are worth and what the economy can actually support. And when that gap snaps shut, it won't be a gentle correction. It will be a wealth transfer. The question isn't if the UK housing crash is coming. The data shows it's already here. It's just invisible to the naked eye. By the end of this video, you are going to see the matrix. You're going to understand the 3 hidden triggers that are about to pull the rug out from under the British middle class. And more importantly, you'll know exactly how to position yourself so that while others panic, you profit. Let's start with the illusion. It feels safe, doesn't it? You walk down your high street and the estate agents still have photos in the window with ambitious price tags. Your neighbor just listed their house for 10 grand more than they paid for it. On the surface, the UK property market looks like the unshakable pillar of wealth it has been for the last 40 years. But markets don't crash when everyone expects them to. They crash when everyone is looking the other way. To understand why UK house prices are about to tank, you have to ignore the asking prices. Asking prices are just wishes. They are the psychology of the seller, anchored in the past. Instead, we need to look at the transactional volume and the cost of debt.
Think of the market like a car engine. The car is still moving forward at 30 miles per hour, so the passengers think everything is fine. But under the bonnet, the oil has run dry. The pistons, the misfiring, and the heat is building up. That is the UK housing forecast right now. Momentum is carrying us forward, but the mechanics have failed. We are currently living through the greatest disconnect between wages and house prices in history. But that's not the trigger. High prices alone don't cause a crash. What causes a crash is when the mechanism that supports those prices breaks, and that mechanism is cheap debt. For 15 years, the UK property investment strategy for millions of people was simple: buy anything, wait, and refinance. It was easy because money was free. But the era of free money is over, and the hangover is about to set in. Let's talk about the data that mainstream media glosses over. They talk about the Bank of England base rate as if it's a temporary inconvenience. They say, "Oh, rates will come down next year." Even if they do, it doesn't matter. The damage is already baked into the system. Here is the concept you need to burn into your brain: the lag effect. Monetary policy, raising interest rates, takes between 18 and 24 months to fully hit the economy. The Bank of England started hiking rates aggressively over a year ago. That means the real pain hasn't even hit the bloodstream yet. We are walking around with a delayed reaction. Consider the fixed-rate cliff. In the UK, unlike the US where you can fix a mortgage for 30 years, most people fix for 2 or 5 years. Right now, as you watch this, over 1.6 million households are coming to the end of cheap fixed-rate deals they secured when rates were near zero. Imagine a family, let's call them the Smiths. They bought a semi-detached house in Manchester or a flat in London in 2021. They were stress-tested at 3%, but they were paying 1.5%. Their mortgage was £800 a month. Manageable. Next month, their fix ends. They go to refinance. Suddenly, the rate is 5 or 6%. Their payment jumps from 800 to 1,300. That is an extra £500 a month. That is £6,000 a year of post-tax income gone, vanished. Now multiply the Smiths by 1.6 million. That is billions of pounds of purchasing power sucked out of the economy. But here's where it gets darker. The Smiths aren't going to sell immediately. They will cut back. They will cancel Netflix, stop eating out, maybe sell the second car. They will fight to keep the house. But what happens when they can't fight anymore? What happens when unemployment starts to tick up because businesses are also facing higher borrowing costs? That is when the forced selling begins. And forced selling is the only thing that matters in a crash. When you analyze UK real estate investing, you have to look for the distressed seller. Right now, the distressed seller is being created behind closed doors, agonizing over spreadsheets, realizing the numbers no longer work.
If homeowners are the shield of the market, investors are the sword. And right now, the sword is dulling. For decades, buy-to-let was the golden ticket. It was the retirement plan for the British middle class. But the government has systematically dismantled the business model of the small landlord. It started with Section 24, removing the ability to deduct mortgage interest from your taxes. At low interest rates, this was annoying. At high interest rates, it is lethal. I want you to do the math with me. It's terrifyingly simple. You have a rental property bringing in £1,000 a month. Your mortgage used to be £300. You made £700 profit, and you paid tax on that. Life was good. Today, your mortgage is £800. You have £200 cash flow. But wait, because of Section 24, the government taxes you on the revenue, not the profit. You might end up with a tax bill that is higher than your actual profit. You are literally paying the government for the privilege of housing a tenant. You are subsidizing the tenant to live in your house. This is why we are seeing a mass exodus of amateur landlords. They are looking at their portfolios and realizing they are insolvent. Is now a good time to buy property in the UK? For them, it's the best time to sell. And who are they selling to? Other investors? No, because the numbers don't stack for them either. They have to sell to owner-occupiers. But remember the Smiths? The owner-occupiers can't afford the mortgage payments. So you have a flood of supply coming from landlords exiting the market, meeting a wall of buyers who cannot get financing. When high supply meets zero demand, there is only one direction for prices to go: down. This brings us to the psychological phase we are in right now, the standoff. If you look at the data, transaction volumes have fallen off a cliff. Estate agents are sitting in empty offices. Why? Because sellers are living in 2021 and buyers are living in reality. A seller thinks, my neighbor sold for £400,000 2 years ago. I'm not accepting a penny less. They are anchored to that price. They view their home equity as their savings account. To sell for less feels like losing actual money. So they sit, they wait, they withdraw the listing. This creates a phony war. Prices look stable because nobody is trading. But this liquidity freeze is the precursor to the crash. The dam breaks when the 3 Ds kick in: death, divorce, and debt. You can delay selling because you want a high price. You cannot delay selling when you get divorced and need to split the asset. You cannot delay when you lose your job. You cannot delay when the bank forecloses. As the economy tightens, the 3 Ds increase. These sellers must sell. They will lower the price to $380, then $360, then $340. Once those comparables hit the land registry, the game is up. The neighbor who wanted $400,000 now has to accept that the bank valuer says the house is worth £340,000. The illusion of wealth evaporates instantly. This is the stickiness of the housing market. It moves slowly, unlike the stock market. But when the psychology shifts from fear of missing out to fear of overpaying, the floor falls out. But here is the twist. While the small landlord is being squeezed out and the homeowner is panicking, something else is happening. Something that feels almost coordinated. The big boys are moving in. We are seeing a structural shift in UK housing from a nation of homeowners to a nation of renters. But not rented from Dave down the pub, rented from mega corporations. You've heard the rumors about the Great Reset, right? You will own nothing and be happy? Look at the UK property investment strategy of major institutions. Lloyds Bank wants to become one of the UK's biggest private landlords. John Lewis is building rental homes. Hedge funds are raising billions to buy build-to-rent portfolios. Why would they do this if the market is about to crash? Because they aren't buying yet. They are raising the cash. They are sharpening their knives. They know the crash is coming. In fact, they are banking on it. They are waiting for the insolvency. They are waiting for the mom-and-pop landlords to capitulate. They have a distinct advantage over you: cost of capital. They don't pay 6% mortgage rates. They access institutional debt at much lower levels. They can buy in cash. When the crash happens, let's say UK house prices drop by 20 or 30%, these institutions will swoop in and vacuum up the inventory. This creates a terrifying future where home ownership becomes a luxury reserved for the elite and everyone else pays a subscription fee for a roof over their head. This is why this information is urgent. If you're a small investor or a prospective home buyer, you are not just competing against other people like you. You are competing against global capital that wants to turn your home into a yield-generating asset on a balance sheet. Let's get grounded in the raw numbers again, because numbers don't lie. Emotions lie. Politicians lie. Ratios tell the truth. The price-to-earnings ratio in the UK, the cost of a house divided by the average yearly wage, is at historic highs. In the 1990s, a house cost about 3 to 4 times the average salary. Today, in many parts of the South, it is 8, 9, or 10 times. For a market to be sustainable, people have to be able to buy the product. It's that simple. If interest rates stay at 4 or 5% and wages don't double overnight, which they won't, then mathematically, house prices must come down to meet affordability. There is a ceiling. We hit it. And don't look at the nominal price, look at the real price. If inflation is running at 5% and your house price stays the same, you have lost 5% of your value in real terms. We are likely to see a scenario where house prices stagnate in nominal terms for a decade, but lose 30 to 40% of their value against inflation. This is the silent crash. You feel like your house is still worth 300,000, but that 300,000 buys you significantly less than it did 5 years ago. It's a slow-motion erosion of wealth that most people won't notice until they try to cash out and realize their retirement pot doesn't stretch as far as they thought. We cannot look at the UK property market in a vacuum. We are an island, but our economy is not. The UK housing forecast is heavily tied to the bond market, the gilts. Remember the mini-budget? Remember how fast mortgage rates spiked? That showed us how fragile the system is. If global energy prices spike again, or if there is another supply chain crisis, inflation roars back. If inflation comes back, the Bank of England has to raise rates again or keep them higher for longer. The market is currently pricing in cuts. Rates will drop soon, screams the newspaper. But what if they don't? What if we enter a period of stagflation, stagnant growth and high inflation? That is the worst-case scenario for property. In a recession, people lose jobs, so they can't pay mortgages. In high inflation, costs of living rise, so they can't pay mortgages. Stagflation is both at once. We are also seeing a tightening of credit availability. Banks are scared. They are looking at the same data I am showing you. They are tightening their lending criteria. They are downvaluing properties. If the bank says the house is worth less, the buyer has to find a bigger deposit. Most buyers don't have it. The deal collapses, the chain breaks, the market stalls. So, is it all doom and gloom? Is the sky falling? No. Chaos is a ladder. Every market crash has winners and losers. The losers are the ones who are over-leveraged, undereducated, and operating on denial. The winners are the ones who understand liquidity. The winners of the next 5 years will be the cash kings and the creative structurers. If you have cash or access to private investors, a crash is a sale. It's Black Friday for assets. When blood is on the streets, that is when fortunes are made. But even if you don't have millions in the bank, there are strategies that thrive in this environment. Strategies that the mainstream gurus aren't talking about. We are going to see a rise in creative finance, lease options, vendor finance, buying subject to mortgage.
Imagine a seller who is about to be repossessed. They have very little equity, they just want out. They want to save their credit score. You can step in, agree to cover their mortgage payments, and take control of the property without needing a new mortgage yourself, provided it is structured correctly. These strategies only work in a distressed market. In a booming market, sellers tell you to get lost. In a crashing market, you are a lifeline. The dumb money is currently trying to time the bottom. They are sitting on their hands. The smart money is building relationships with estate agents, learning how to spot motivated sellers, and lining up their financing so they can strike when the panic sets in. We also need to destroy the myth of the UK property market. There is no such thing. There is a London market, a Manchester market, a distinct market in a tiny village in the Cotswolds. London and the Southeast are the most exposed. Why? Because the yields are terrible. You buy a flat for $500,000 and rent it for $2,000. The numbers don't work at 6% interest. London relies on capital appreciation. When appreciation stops, the rationale for investing in London evaporates. However, look north. Look at the Midlands. Look at areas where you can still buy a house for 120 grand and rent it for 750. The yields are higher. These markets are more insulated because the mortgage payments are smaller relative to wages. But even there, the ripple effect will be felt. The work-from-home boom that pushed prices up in rural areas is reversing. Companies are demanding people come back to the office. Those who moved to the countryside and drove prices up are now having to sell and move back to the city. You need to be hyper-local. Don't ask, is the UK market crashing? Ask, is the 3-bedroom semi-detached market in this specific postcode crashing? So let's play this out. What does the next 24 months look like? Phase 1 is denial. That is where we are now. Sellers are holding on, volume drops, the media is confused. Phase 2 is realization. Fixed rates expire, distress rises, inventory creeps up. Phase 3 is correction. Comparable sales validate lower prices. Banks down value. The headline numbers drop. Phase 4 is overshoot. Panic sets in. Prices drop below fair value. Phase 5 is recovery. Smart money steps in. The cycle resets. Most people will panic in Phase 4. They will sell at the bottom. You, watching this, need to prepare for Phase 4. That is your entry point.
But you cannot wait until it happens to prepare. You need to be market fit now.
Do you have your credit score in order? Do you have your team, mortgage broker, solicitor, surveyor ready? Do you know your area's prices down to the square foot? The UK housing crash isn't a disaster, it's a reset. It is the market clearing out the excesses of a zero-interest rate decade. It is scary if you are unprepared. It is terrifying if you are over-leveraged. But if you have educated yourself, if you understand the data we've discussed today, you don't need to fear it. You are now part of the minority who sees the iceberg before the ship hits it. The days of buying a property, painting it grey, and making £50,000 are over. The days of strategic, data-driven investing are just beginning. Don't let the fear paralyze you. Let it sharpen you. The wealth transfer is coming. Ensure it transfers to you, not away from you. If you want to stay ahead of this curve, if you want the deep dive strategies on how to navigate this specific volatility, you need to subscribe. I'm going to be breaking down every shift, every policy change, and every opportunity as it happens. The market is changing. Make sure you change with it. Don't be the last to know.